Between 2020 and 2025, the United States economy experienced disruptions that tested nearly every assumption about how modern markets, labor systems, and monetary policy function under stress. What emerged wasn't collapse or recovery in the traditional sense, but adaptation. The mechanisms that govern how Americans work, spend, borrow, and build wealth shifted in ways that weren't immediately visible, but became structural. Understanding these shifts requires looking not at what people feared would happen, but at what actually changed in how the system operates. The U.S. economy is not a single entity, but a collection of interlocking systems. Labor markets that determine employment and wages, consumer markets that drive spending and production, housing markets that shape wealth accumulation, financial markets that allocate capital, and monetary policy that influences all of these through interest rates and money supply. Each system operates according to incentives, constraints, and feedback loops. When external shocks disrupt one system, the effects cascade through others, forcing adaptation. The period from 2020 to 2025 produced a sequence of such shocks: pandemic-related shutdowns, supply chain disruptions, labor shortages, inflation spikes, aggressive interest rate increases, and technological shifts in how work is performed. By 2026, the economy that emerged from this sequence looks fundamentally different in its structure and incentives than the one that existed in 2019, even if many surface-level indicators appear familiar. To understand what changed, it's necessary to establish what the system looked like before. From roughly 2010 to 2019, the U.S. economy operated under a specific set of conditions that shaped expectations and behavior. Interest rates remained historically low following the 2008 financial crisis, making borrowing cheap for consumers, businesses, and government. This environment encouraged debt-financed spending and investment. Unemployment fell steadily, reaching levels not seen in decades, but wage growth remained moderate, keeping inflation subdued. Workers had leverage in hiring negotiations, but not enough to drive sustained price increases. Housing prices recovered from the 2008 crash and climbed steadily, creating wealth for homeowners, but making entry increasingly difficult for first-time buyers. Stock markets rose consistently, benefiting investors and retirement accounts. Globalized supply chains kept consumer goods inexpensive, and just-in-time manufacturing minimized inventory costs. The Federal Reserve operated with the understanding that inflation would remain low and that stimulating growth was the primary challenge. Consumers and businesses made long-term decisions based on these conditions persisting, borrowing at low rates, investing in assets expected to appreciate, and planning for predictable input costs. In March 2020, pandemic-related shutdowns severed the connection between labor supply and demand almost overnight. Millions of workers left jobs in service industries, hospitality, and retail, while certain sectors like delivery, warehousing, and technology saw surges in demand. The federal government responded with unprecedented fiscal transfers, expanded unemployment benefits, direct payments to households, loans to businesses, and support for state and local governments. These measures injected trillions of dollars into the economy at a time when production capacity was constrained by shutdowns and supply chain disruptions. The money arrived, but the goods and services did not. At the same time, the Federal Reserve lowered interest rates to near zero and purchased massive quantities of government and mortgage-backed securities, expanding the money supply. The intent was to prevent financial collapse, but the effect was to flood the system with liquidity while production remained limited. Savings rates spiked as households accumulated cash they couldn't spend on services and experiences. When restrictions lifted, this accumulated savings collided with constrained supply. Prices began rising in 2021, first in used cars, then housing, then food, energy, and wages. By 2022, inflation reached levels not seen since the early 1980s. The Federal Reserve, which had maintained that inflation was transitory, reversed course and began raising interest rates aggressively. Between March 2022 and mid-2023, rates increased from near zero to over 5%, the fastest tightening cycle in decades. This shift fundamentally altered the incentive structure across the economy. The labor market that emerged from the pandemic disruption operates differently than the one that preceded it. Millions of workers who left jobs in 2020 did not return to the same roles or sectors. Some retired earlier than planned. Others shifted to different industries where remote work was possible, or working conditions were perceived as better. Sectors like hospitality and retail faced persistent labor shortages even as unemployment returned to low levels. This mismatch between where workers were needed and where they were willing to work gave remaining workers significant bargaining power. Wages increased sharply in low-wage sectors, compressing wage differentials between entry-level and mid-level positions. Employers responded by raising wages, offering signing bonuses and increasing flexibility, but also by accelerating automation and reducing service levels. Fast food chains installed ordering kiosks. Retailers expanded self-checkout. Warehouses deployed more robots. The result was not mass job loss, but a shift in what kinds of labor were demanded. Remote work, which had been a niche arrangement before 20, became standard in many white-collar sectors. Companies that resisted remote arrangements lost workers to competitors who offered it. This shift had cascading effects on where people chose to live, what kinds of housing they sought, and how they spent money. Workers who had spent on commuting, office attire, and city center lunches redirected that spending toward home offices, suburban housing, and local services. By 2026, the labor market reflects these adjustments. Unemployment remains low, but the composition of employment has shifted. Service sector jobs pay more, but are fewer in number. Remote work is entrenched in certain sectors and nearly absent in others. Workers expect flexibility, and employers that can't offer it face higher turnover costs. Understanding inflation requires distinguishing between price increases driven by demand and those driven by supply constraints. In 2021 and 2022, both factors operated simultaneously. Demand was elevated due to accumulated savings and continued fiscal support. Supply was constrained due to disrupted global supply chains, energy market dislocations following geopolitical events, and labor shortages. The Federal Reserve's tool for controlling inflation is the federal funds rate, which influences borrowing costs across the economy. When rates are low, borrowing is cheap, encouraging spending and investment. When rates are high, borrowing is expensive, discouraging spending and investment. By raising rates sharply starting in 2022, the Federal Reserve aimed to cool demand enough to bring prices back in line with supply. The mechanism operates through several channels. Higher mortgage rates slow housing demand, reducing construction and related spending. Higher corporate borrowing costs reduce investment in expansion and hiring. Higher consumer loan rates reduce spending on cars, appliances, and other financed goods. The effect is to slow economic activity broadly, which reduces pressure on prices, but also carries the risk of recession. What made this cycle unusual was the starting point. Rates had been near zero for over a decade, and an entire generation of borrowers and investors had never experienced a high-rate environment. Homebuyers who could afford houses at 3% mortgage rates found themselves priced out at 7%. Businesses that had relied on cheap debt to fund growth faced higher costs and slower expansion. Consumers who had refinanced debt at low rates were insulated, but new borrowers faced significantly higher costs. By 2026, inflation has moderated from its 2022 peak, but remains above the Federal Reserve's 2% target. Interest rates, while lower than their peak, remain elevated compared to the 2010s. This creates a fundamentally different environment for financial decision-making. Housing in the United States functions both as shelter and as the primary vehicle for wealth accumulation for most households. Homeownership allows families to build equity, benefit from price appreciation, and lock in predictable housing costs through fixed-rate mortgages. Renters, by contrast, face rising costs without building equity. This dual function makes housing markets central to understanding broader economic dynamics. Between 2020 and 2022, housing prices surged. Low mortgage rates, remote work enabling geographic flexibility, and limited housing supply drove intense competition. Homeowners who bought or refinanced during this period secured historically low rates, insulating them from future rate increases. But first-time buyers entering after rates rose faced a double challenge: elevated prices and high borrowing costs. The result is a bifurcated housing market. Existing homeowners with low-rate mortgages have little incentive to sell, reducing inventory and keeping prices elevated. Renters face rising rents as demand for rental housing increases among those unable to buy. New construction, which could alleviate supply constraints, slowed as builders faced higher financing costs and regulatory barriers in many markets. By 2026, Housing markets vary significantly by region. Some cities that saw explosive growth during the pandemic have cooled. Others continue to face severe shortages. The common thread is that housing affordability, defined as the relationship between income, prices, and borrowing costs, remains constrained for new entrants, while existing owners have largely been insulated. Consumer spending drives roughly 70% of U.S. economic activity, making household behavior central to overall growth. How consumers allocate spending, whether they borrow or save, and how they respond to changing prices all shape economic outcomes. During the pandemic, household finances improved dramatically despite the shock. Government transfers exceeded lost income for many households. Reduced spending on services like travel and dining meant savings rates spiked. Credit card debt fell as people paid down balances. By 2021, households were in the strongest aggregate financial position in decades. This strength fueled spending as restrictions lifted. But as inflation eroded purchasing power and interest rates rose, behavior began to shift. The excess savings accumulated during the pandemic have now been largely spent, particularly among lower and middle-income households. Credit card balances have risen back to pre-pandemic levels, but now at higher interest rates. Auto loans, which surged as used car prices spiked, now carry higher rates and longer terms, stretching budgets. Student loan payments, paused for over 3 years, resumed in late 2023, removing hundreds of dollars per month from millions of household budgets. The result is a consumer sector that appears resilient in aggregate, but faces increasing strain at the household level. Spending continues because employment remains strong, but the cushion of excess savings is gone. Debt levels are rising, and servicing that debt costs more. This creates vulnerability to shocks like job loss or unexpected expenses that would have been more easily absorbed in earlier years. By 2026, consumer spending continues to grow, but at a slower pace than in the immediate post-pandemic period. Households are more sensitive to price changes and more selective about discretionary purchases. The shift is subtle, but measurable in how spending patterns have changed. Small businesses, which employ roughly half of the private sector workforce, experienced the pandemic and its aftermath in distinct ways. Many closed permanently during shutdowns, unable to sustain operations without revenue. Others survived through government loan programs, but emerged with new debt obligations. Those that remained faced labor shortages that forced wage increases and operational changes. Consider a restaurant that operated profitably in 2019 with 20 employees, moderate wages, and predictable food costs. During shutdowns, it shifted to takeout only, reducing staff and revenue. When reopening was possible, finding workers required raising wages significantly. Food costs had increased due to supply chain disruptions. Rent, if not reduced through negotiation, remained a fixed burden. The restaurant faced a choice: raise prices, reduce service, or close. Many chose to raise prices, contributing to the inflation consumers experienced. But there were limits to how much prices could increase before demand fell. Some restaurants reduced hours, cutting lunch service or closing additional days per week. Others invested in technology, like online ordering and payment systems, to reduce labor needs. By 2026, the restaurant landscape has contracted. Fewer establishments exist, but those that survived have adapted to higher costs through a combination of price increases, technology adoption, and service model changes. The experience illustrates the broader pattern. Businesses that could adapt to higher labor costs and operational challenges survived, while those with thin margins or inflexible models did not. Looking at economic policy over decades reveals a recurring pattern. Crises trigger aggressive government intervention and monetary stimulus. This support prevents immediate collapse, but often creates imbalances. Eventually, those imbalances require correction through restraint. Higher rates, reduced spending, or regulatory adjustment. Each cycle shapes the next. The 2008 financial crisis led to over a decade of low interest rates and quantitative easing. This created an environment where asset prices inflated, debt levels rose, and expectations of continued low rates became embedded. When the pandemic crisis arrived, policymakers responded even more aggressively because the 2008 experience suggested that aggressive action worked. But the 2020 crisis was different. It was a supply shock accompanied by demand stimulus, creating inflation rather than deflation. The policy tools designed for one type of crisis were applied to another, with unintended consequences. By By 2026, policymakers face a different challenge. Interest rates are higher, making traditional stimulus through rate cuts less immediately available. Debt levels, both government and private, are elevated, constraining fiscal options. The options available for responding to the next shock, whatever it may be, are more limited. This doesn't predict what will happen next, but it describes the constraints within which future responses will occur. The structural changes in labor markets, interest rates, housing, and consumer finance create specific incentives for individual decision-making. Workers in sectors that adopted remote work have gained geographic flexibility, but also face potential competition from a broader labor pool. The value of specific credentials and skills has shifted. Technical skills, particularly in areas related to automation and digital systems, command premiums. Workers without these skills face pressure to adapt or accept lower relative wages. In housing, the decision between renting and buying now depends heavily on local markets, income stability, and expected mobility. The traditional calculus that buying always builds wealth no longer holds universally when high mortgage rates and elevated prices combine. Renters who would have bought in earlier years now face the question of whether to wait for conditions to improve or accept current terms. For savers and investors, higher interest rates mean cash, and bonds offer real returns again, after years of near-zero yields. This makes holding cash less costly and changes the relative attractiveness of different investment options. Stocks, which benefited from years of low rates driving investors toward riskier assets, no longer have the same advantage. In household budgeting, higher debt servicing costs mean less flexibility. Families that could absorb unexpected expenses through savings or borrowing now find both options more constrained. Emergency funds, which seemed less urgent when access to credit was cheap and easy, have become more important. None of these implications suggest a specific action is correct for everyone. They describe how the system's structure creates different trade-offs than existed in the previous decade. By 2026, the U.S. economy operates under a different set of baseline conditions than it did in 2019. Interest rates, while no longer at their recent peaks, remain structurally higher than the post-2008 era. This affects borrowing costs across the economy and changes how businesses, households, and governments make long-term decisions. Labor markets have recalibrated around new expectations for wages, flexibility, and working conditions, with automation accelerating in sectors where labor costs rose most. Housing remains a constrained market, with affordability challenges for new entrants and wealth accumulation concentrated among existing owners. Consumer behavior reflects the exhaustion of pandemic-era savings and the return of debt growth, creating less cushion against future shocks. What makes this period distinctive is not that any single indicator looks unprecedented, but that multiple systems shifted simultaneously, creating a new configuration of incentives and constraints. Workers, businesses, investors, and policymakers all operate within this adapted structure, making decisions based on the conditions that now exist, rather than those that existed before 2020. Understanding how the economy adapted requires looking at mechanisms rather than narratives, at structural changes rather than emotional reactions, and at how systems function rather than predictions about where they lead. The economy in 2026 isn't waiting to return to some previous normal. It has already established a new one, and the choices individuals and institutions make within that structure will shape what comes next. Thanks for watching. If you're trying to understand what's actually changing around you, subscribe. Like the video, so this reaches more people who feel the same way.